What if I told you that you could collect rent from shopping malls, office towers, and industrial hubs across Singapore without ever buying a single property? No bank loan, no tenants calling you at 3 a.m., no dealing with broken toilets or maintenance headaches. That's the power of REITs, one of Singapore's best-kept secrets for building passive income and achieving financial freedom. But should you invest in individual REITs or REIT ETFs? And how much can you really earn? Stay till the end of this video because I'll break it all down for you, including real numbers, strategies, and the best way to invest, even if you don't have millions to buy a condo. And if you find this helpful, hit like and subscribe. It really helps the channel grow and brings you more tips on how to make your money work for you. Segment 1. Why REITs? In Singapore, real estate has always been one of the best ways to build wealth. Property values rise over time, and rental income provides passive cash flow. The problem? Buying a private condo today is crazy expensive. A typical private condo in Singapore costs around $1.5 million to $2 million. You need at least 25% down payment, about $375,000 to $500,000 in cash and CPF. Then, you're stuck with a 30-year bank loan, where your monthly mortgage could be $4,000 to $6,000. And even after buying, you have to deal with tenants, maintenance, property taxes, and agent fees. What if there was a way to own income-generating property without the massive costs and headaches? That's where REITs come in. A REIT is like owning property, but without all the problems. Instead of spending hundreds of thousands on a single condo, you can start investing in REITs with just a few $100s. With REITs, you co-own hundreds of commercial properties, shopping malls, office towers, industrial parks, and get rental income every few months. Would you rather take on $1 million mortgage or start earning passive income with just a few clicks? This is why more and more Singaporeans are turning to REITs as a better, smarter way to invest in real estate. Segment 2. How REITs work. What exactly is a REIT? REITs are companies that own income-generating real estate, malls, offices, warehouses, hotels. They collect rent and pay out 90% of their income as dividends. The average dividend yield is 4 to 6% per year, meaning a $100,000 investment could earn you $5,000 to $6,000 annually. What about REIT ETFs? A REIT ETF is like a set meal. You get instant diversification across multiple REITs. Instead of picking individual REITs, you can invest in a basket of top-performing REITs in Singapore and Asia. Less research, lower risk, and automatic diversification. Segment 3. Benefits of REITs and REIT ETFs. Why are REITs one of the best passive income tools for Singaporeans? Affordable. Start small, grow big. Unlike buying a private condo, which requires a huge down payment of $375,000 to $500,000, you can start investing in REITs with just a few $100s. This makes REITs accessible to everyone, whether you're a beginner or an experienced investor. Liquidity. Buy and sell anytime. Selling a property in Singapore can take months and requires dealing with agents, paperwork, and stamp duties. With REITs, you can buy or sell instantly on the stock exchange, just like stocks. Need cash urgently? You don't have to wait months to find a buyer. Instant diversification. Own multiple properties, not just one. Buying a private condo means all your money is stuck in one property. If the rental market drops, you're in trouble. REITs spread your risk across multiple properties. Instead of just one condo, you could be co-owning 50-plus properties across shopping malls, office towers, and industrial parks. Even if one tenant leaves, other properties continue generating income. Hassle-free. No property management stress. Owning a rental property means dealing with tenants, leaking pipes, property taxes, and maintenance fees. With REITs, professional managers handle everything. You just collect your dividends every quarter. No phone calls at midnight about a broken aircon. Inflation protection. Rents and property values rise over time. Over the long run, rental prices increase with inflation, which means REITs can provide growing dividends. This helps protect your wealth from rising costs, making REITs a great long-term investment. Bottom line? REITs let you enjoy the benefits of real estate investing, without the massive costs, debt, or headaches. It's one of the simplest and smartest ways to build passive income in Singapore. Segment 4. REITs vs REIT ETFs. Which one is better? Individual REITs are ideal for investors who want full control over their investments. You can handpick specific REITs based on your preferred sector, whether it's shopping malls, office spaces, industrial properties, or data centers. This approach offers higher potential returns if you carefully research and choose strong-performing REITs. However, it requires active management. You'll need to track earnings reports, interest rate movements, and economic conditions. On the other hand, REIT ETFs are best for hands-off investors who want instant diversification without the need for extensive research. Instead of picking individual REITs, a REIT ETF gives you exposure to a basket of top-performing REITs in Singapore and Asia. It involves less effort, lower risk, and you still receive regular dividends. Want a simple, hassle-free way to invest in REITs? The CFA REIT ETF, also known as the Nikko AM-STC Asia REITs ETF, is a great option because it includes top-quality REITs across Singapore and Asia. It is diversified across more than 40 REITs, reducing individual REIT risks. Plus, you can even buy it using your CPF OA funds, making it a great way to earn higher returns than CPF's 2.5% interest. So, bottom line, if you have the time to research and optimize your portfolio, go for individual REITs. But if you want an easy way to invest and diversify instantly, the CFA REIT ETF is your best bet. Segment 5. Who should invest in REITs? If you're in your 20s or 30s, your main focus should be growing your wealth, which means investing in growth stocks like tech and index ETFs, such as SPY, QQQ, or MSCI World ETFs. However, don't ignore passive income early on. Allocating 10 to 20% of your portfolio into REITs and REIT ETFs can provide steady dividends while you build your core growth portfolio. This protects part of your portfolio from market volatility while still letting you reinvest dividends for compound growth. The best approach is a mix of REIT ETFs for stability and a few individual REITs for higher returns. By your 40s and 50s, you're likely earning more and looking for financial stability. This is the time to increase your allocation in REITs to 30 to 50% to generate steady cash flow while still keeping some growth assets. Balancing REITs and stocks ensures your wealth continues growing, but also gives you reliable dividends to reduce reliance on salary income. Once you stop working, your investments should generate consistent income for daily expenses. REITs should make up a significant portion, 60 to 80% of your portfolio, especially stable blue-chip REITs or REIT ETFs, like CFA REIT ETF for long-term security. With a $1 million REIT portfolio yielding 5%, you could generate $50,000 per year, or $4,166 per month, in passive income, enough to cover living expenses without touching your capital. Bottom line, in your 20s and 30s, focus on growth stocks, but allocate 10 to 20% into REITs for passive income. In your 40s and 50s, shift 30 to 50% into REITs to balance growth and stability. And in your 60s and beyond, prioritize 60 to 80% REITs to maximize retirement income. No matter your age, REITs help build a strong financial future. Segment 6. Example: building a REIT portfolio. Let's say you want to build a solid REIT portfolio for passive income. Start with blue-chip REITs, which should make up 70 to 80% of your portfolio. These are the safest, most reliable REITs with strong track records and stable dividends. Examples include Capitaland Integrated Commercial Trust, Mapletree Industrial Trust, Ascendas REIT, and Fraser's Centerpoint Trust. Next, add mid-cap REITs, which should make up 15 to 20% of your portfolio. These offer higher dividend yields but come with slightly more risk. Examples are Ames APAC REIT and CDL-H Trust. If you don't want to pick individual REITs, go for a REIT ETF. With a $100,000 portfolio at a 5.5% dividend yield, that's $5,500 per year in passive income or $458 per month, enough to cover utilities, transport, and even some meals. Conclusion: start building your passive income today. So, should you invest in REITs or REIT ETFs? If you want passive income but don't have time to research, REIT ETFs are the best option for instant diversification and hassle-free investing. If you enjoy picking your own investments and want higher returns, individual REITs allow you to customize your portfolio and potentially outperform ETFs over time. But here's the real key: you don't have to choose just one. A smart approach is to combine both, using REIT ETFs for stability and individual REITs for growth. Either way, starting today will bring you one step closer to financial freedom. What do you think? Are you investing in REITs or REIT ETFs? Or are you considering a mix of both? Comment below. I'd love to hear your thoughts. And if you found this video useful, don't forget to like, subscribe, and hit the bell icon so you won't miss future investing tips. See you in the next video.